Let's now move on to the second type of transaction within irrecoverable debt expenses. Irrecoverable debts that were written off and are later paid by the customer. To begin, let's clarify when this situation arises. An irrecoverable debt is an amount owed by a customer that the business has judged to be uncollectible and has therefore removed from the trade receivables balance. However, there are occasions where a customer later makes a payment, either in full or in part, after the debt has already been written off. This may occur if the customer's financial circumstances improve or if they decide to settle the outstanding balance. When this happens, the business must reverse the original write-off because the earlier assumption that the debt was uncollectible is no longer accurate. Now, let's look at the double entries involved. When the customer pays, we debit cash at bank in the statement of financial position to record the receipt of cash. We then credit irrecoverable debt expense, which reverses the expense that was recognized when the debt was first written off. This ensures that the financial statements reflect the reality of the situation. The business has now received cash and the earlier loss is no longer appropriate. A key point to remember is that no adjustment is made to the trade receivables account. The receivable was derecognized at the time of the write-off, meaning the asset was removed from the statement of financial position because it no longer met the definition of a recoverable asset. Since the receivable no longer exists in the accounting records, it cannot be adjusted again. We also do not adjust revenue because the revenue recognition criteria were met at the point of sale. The business delivered the goods or services, and the performance obligation was satisfied. It's also worth noting that the recovery may be partial or complete. Regardless of the amount received, the accounting principle remains the same. Recognize the cash received and reduce the irrecoverable debt expense by the corresponding amount. To finish this section, we will now look at practical example 2, which illustrates how these double entries are applied in this type of transaction. Let's go through another practical example, and this time we're looking at what happens when a bad debt that was previously written off is later recovered. Here is the requirement. A customer purchases a car on credit for £10,000. Subsequently, due to financial difficulties, the customer is unable to meet the repayment obligations and defaults on the outstanding balance. After assessing the situation, the car company determines that the debt is irrecoverable and decides to write it off. At a later date, the customer makes a payment of £10,000 to fully settle the outstanding debt. If you'd like to read that again, feel free to pause the video and come back when you're ready. Now let me explain the scenario in simpler terms. A customer originally bought a car on credit for £10,000. Later on, they ran into financial trouble and couldn't pay, so the company assessed the situation and decided the debt was irrecoverable. At that point, the balance was written off. Now imagine that sometime later, the customer unexpectedly pays the full £10,000. How do we record this? The journal entry is actually very straightforward. We start by debiting cash at bank £10,000 to record the cash received. And we then credit irrecoverable debt expense £10,000 to reverse the expense that was recognised when the debt was written off. And notice something important here. We do not adjust trade receivables. That adjustment already happened when the debt was written off. At this stage, we're simply reversing the expense and recognising the cash inflow. In the statement of profit or loss, administrative expenses decrease by £10,000 because we're reversing part of the irrecoverable debt expense. In the statement of financial position, cash increases by £10,000 to reflect the money received, whereas trade receivables remain unchanged because they were reduced at the time of the original write-off. When a previously written-off debt is later paid, whether fully or partially, we reverse the irrecoverable debt expense. We do not reinstate the receivable. This type of question is very commonly tested in the Accounting Fundamentals exam. Examiners like scenarios where a debt is written off and then later recovered because it checks whether you understand the flow of entries and the impact on the financial statements, so that the double entries reflect the correct treatment of a recovered bad debt. Finally, let's look at a scenario involving dishonored payments. This isn't one of the most frequently tested areas, but it does appear occasionally, so it's worth being prepared for it. A dishonored payment happens when a customer has made a payment, but the electronic transfer of funds is not processed by the bank as expected. This is usually due to an administrative issue at the bank. It's not about the customer refusing to pay or being unable to pay. The cash simply never arrives. And it's important to understand that this type of transaction does not necessarily involve a bad customer. It is normally just a banking or processing error. Before we look at the dishonored entry, let's quickly remind ourselves of the original double entry that would have been recorded when the business believed the customer had paid. When the payment was first received, we would have debited cash at bank because we thought the money had arrived, and we would have credited trade receivables because we believed the customer's debt had been settled. That's the standard entry for a cash receipt from a customer. Now, because the payment has been dishonored, that original entry is no longer correct. The business hasn't actually received any cash, and the customer still owes the money. So we need to reverse the original receipt. So how do we deal with this in the accounts? The key point is that we need to reinstate the trade receivable because the business hasn't actually received the money. The original cash entry was incorrect, so we reverse it. The double entry is as follows. We debit trade receivables to bring back the amount owed by the customer. We credit cash at bank to remove the cash receipt that was incorrectly recorded. By doing this, the financial statements now reflect the reality of the situation. The business has not received the cash, and the customer still owes the money. Dishonored payments do not affect the statement of profit or loss because no new income or expense is created. The entire adjustment sits within the statement of financial position. Receivables increase and cash decreases. And this is also why we don't adjust the irrecoverable debt expense here. A dishonored payment has nothing to do with a bad customer or an uncollectible debt. It's simply a banking or processing error. The customer still intends to pay and the debt is still fully recoverable. Because of that, we don't touch the irrecoverable debt expense at all. We just correct the cash and receivables to show what actually happened. To summarize, dishonored payments are simply about reversing the cash entry and reinstating the receivable. We debit the receivable, we credit the cash, and that's all that's happening. This isn't a common exam topic, but it does appear occasionally in the Accounting Fundamentals exam. As long as you remember that we reverse the cash and bring back the receivable, the double entries will fall into place. Now let's look at a practical example to show how dishonored payments work in practice. Let's walk through an example of a dishonored electronic payment step by step. Q. On 10th March, a customer buys goods on credit for £3,000. On 8th April, the customer pays £3,000 via a bank transfer. The business records the receipt and clears the receivable. On 10th April, the bank advises the transfer was dishonored due to an administrative processing error. The cash was never actually received. You can pause the video here and read the question yourself. But let's walk through it together now, assuming you've already had a chance to read it. So let's break this down in simpler terms. A customer bought goods on credit, then made a payment, and the business recorded that payment as normal. But later, the bank tells us the transfer didn't go through. So the cash never actually arrived, and the customer still owes the money. Our job is simply to correct the accounts so they reflect what really happened. Here, our objective is to reverse the cash receipt and reinstate the receivable because the debt still exists. We debit trade receivables for £3,000. This reinstates the customer's debt, they still owe us the money. We credit cash at bank for £3,000. This removes the cash that was incorrectly recorded, since it never actually came in. But in order to understand why we reverse cash and reinstate trade receivables, let's look at the double entries that were created before the dishonour. These aren't required in the exam, but they help you understand how the dishonour arises. Entry 1. The initial sale. We debit trade receivables in the statement of financial position for £3,000. This shows that the customer owes us money. We credit revenue in the statement of profit or loss for £3,000. This records the income from the sale. So at this point, we've recognised both the sale and the receivable. Now, on 8th April, the customer pays £3,000 via bank transfer. The business records this payment and clears the receivable. Entry 2. The payment recorded. We debit cash at bank in the statement of financial position for £3,000. This reflects the cash inflow. We credit trade receivables for £3,000. This clears the customer's debt because we believe the payment has been made. Everything looks straightforward. But then, on 10th April, the bank advises that the transfer was dishonoured. This was due to an administrative processing error, not because the customer is insolvent. In other words, the cash never actually arrived. And this is the double entry for dishonoured payments.